If you get the valuation wrong and the fundamentals right, the outcome never tends to be good. Don't make mistakes picking the wrong governance companies or making errors in terms of chasing a narrative.
Give me an example of a holding that's been up a lot, where you both were like, let's take the position a little higher, but you kind of held back.
I think I'll give you an example of an idea that we missed.
You were too cute about the valuation.
Maybe greedy. I think greedy is the right word.
Yeah.
Since then, the market cap today is, I think, if I'm not mistaken, to $330 billion. So, we miss ideas.
Everyone talks about global investing, global diversification, and the gift city. But what are these terms? How do you invest globally? How do you diversify your portfolio? What does optimum portfolio, which is globally diversified, looks like? In this episode of the Ramneek Kundra Show, we have the people behind the Gift City Fund. Welcome back to the Ramneek Kundra Show. Today we have with us Nataraj Shankar Narayanan and Jayesh Jain. Jayesh heads the research for our Gift City Fund, and Nataraj is the advisor over there. Welcome, guys.
Thank you. Good to see you.
So, Nataraj, you were earlier managing about $2.5 billion, and you were outperforming your benchmark, which was BSE 100, by about 300 basis points, 400 basis points. So, can you just give us the framework that you would apply to manage this money for our Gift City Fund?
The framework essentially is three things. One is fundamentals at the end of the day matter in equity investing. And the fundamentals has to be backed by a reasonable valuation. If you get the valuation wrong and the fundamentals right, the outcome never tends to be good. So these two first principles has always worked. And third thing is that don't make mistakes. And the mistakes come in 2-3 forms: picking the wrong governance companies, or making errors in terms of chasing a narrative, or you do not understand the business and therefore you invested. So these three things I avoid, which is in the third bucket. So to sum up, the first bucket is fundamentals matter. Valuations have to matter for the fundamentals. And third is avoid making mistakes because of commission or poor understanding or lack of rigor in your analysis. And then it has worked for me in the past. And that same principle is what being applied here, or what is being applied to my current other two AIFs, which I manage for the on the India product side. So
okay. So most of the global investing that I have seen being talked about in India is more about like, let's go buy Nasdaq 100 or like Magnificent 7 or stuff like, just go and buy S&P 500. And some people would go too exotic and they would just start venturing into thinking about like, different sorts of countries, which you probably would never even touch. So how do you think about global diversification as part of an investor's portfolio?
very good question. So I think if I were to put myself in the shoe of an investor, which I think is very important, because that's the right way to approach that and guide the investor on that path. A passive is a good place to start. If you don't have any allocation to international, I think an exposure to US, whether S&P 500 or NASDAQ, from a very long-term point of view, the 3, 5, 10-year view, I think would be a good place to start without having to take calls like, oh, China looks good, or Korea looks good, or Japan looks good. I think that's too much of fancy stuff at the right of the start. For a simple global investing part, I think the US indices would be a good place to start. A gold will be a good place to start as a hedge against some of the nonsense that are happening internationally, or has happened in the last 15 years.
What do you mean the nonsense that's happening?
Printing of money left, right, and center without any control over fiscal. Any textbooks that I have read in the past have been thrown out of the window in the last 15
Yeah, this
years.
is Nataraj being polite.
Yeah, he's being very polite.
So therefore, you need that gold as insurance, have that as in a global diversification. Then you make active choices, saying that, could I select an active manager? Could I make those country allocation decisions if I have the right information? I think that's the progression that one would make. Similar to how an Indian investor would choose investing in India.
Right.
It's great to start with a flexi cap fund or a sector fund, but I would not recommend that. start with the index fund, build on top of that a sector fund, a flexi cap fund, and then move on from that.
So, from a broad allocation point of view, where does our portfolio stand today? As far as I understand, we have positions like Adyen, we have Lululemon, we have Trip.com, Tencent. Most people have heard of the biggies like Amazon and probably Tencent, but no one knows what Adyen is. Not many people know what Lululemon is. Some people would have affinity toward the brand, but very few people know about it. So tell me a little about how have you constructed the portfolio, because Adyen seems like a very different kind of a position at the top, and Lululemon is a name which is down 60%, 65% from the, probably 70% now,
70%,
like
yeah.
70% from the top. So how are you going about thinking about these businesses and your portfolio?
Great. So for us, we are unconstrained in our thinking. Wherever we see value is where we go. How do we define value? In the sense that there should be a long-term opportunity for that sector and a company to grow, and that for that growth and a free cash flow, we should be getting that business at a reasonable valuation. And is there a catalyst for that value to be unlocked? If there is no catalyst, a value stock will remain value stock forever, and therefore you'll be stuck with no returns. We need to see catalyst. Sometimes we can predict catalyst, sometimes we cannot predict catalyst. So in cases like Lululemon or a Puma, we believe that the catalyst would come through at some stage in time when consumers come back to buy those products.
So
of
it
themselves,
essentially would be the fundamental, which is growth,
which is growth,
one part of it.
and therefore that's the way 25% of the portfolio is today built. Where we have taken non-consensus ideas and looked through the cycle and then built a portfolio. It's been just around 2 months since we started investing in this portfolio.
Right.
About 60% invested so far. In that 60%, the choices that we have made is essentially in 3 markets, which is Europe, US, and China. As things stand today, we don't have allocations to any other markets. And like I said, we see where we go, where we see more value. And these 3 markets is essentially where we see more value today.
Hold on that thought. Like you were saying that we go where we see value, but I have seen that in the gift presentation that we have a market cap limit of $30 billion and above. And I know Jayesh was a little bit hazy about it because he could have
Those are
gone
like
anywhere.
everything is a soft guidelines. Nothing
Yeah.
is a hard rule.
Okay.
So that just narrows and sharpens the benchmark, which do not follow any active benchmarks. But the way to look at the universe, that first screening has to be happening $30 billion. If you offer me any company which is $2 billion and you're giving me at my 400, I'll take it. I'll take it with both hands.
Okay.
So essentially, the other way to look at it is there are 2,900 companies in the MSCI All Country Weighted Index. If you break it down, we said, how do we manage that? I mean, it's a very long tail index. So we said, let's put a threshold of $30 billion. Koi science nahi hai.
Yeah.
Behind this $30 billion. At $30 billion, the universe narrows down to about 425 companies, which still account for 55-58% of the global market cap. So it's a fairly large representation of the market cap. But having said that, if you look at the portfolio today, close to 10-12% of the portfolio is deployed in companies as low as $3.5 billion market cap to about $18 billion.
Which one is that?
So if you look at
DeLonghi.
DeLonghi,
Okay.
which is an Italian coffee company, stuff like that. So or Nexons, which is into cable and wires in France. So we have made those choices too. The market cap allows us to narrow the universe, bring a lot more sharpness. But as we go and meet companies, travel and meet companies and hear from others, ideas pop up and we make these choices.
So why do we have positions like Adyen, Tencent, Trip.com, Amazon as our largest 4 positions? Can you give me a little bit of rationale? I mean, I have heard, many people have heard of Amazon and how valuable it is in their lives, but very few people have heard of names like Trip.com and Tencent, probably few people have heard. Adyen, I think virtually no one has. So yeah, can you just give me a little bit of background?
He's a
Mm,
guru here.
You start there. I'll add the information if required.
So the simple process is, like I said, we go where we see value, and when we dissect these 4 businesses that we own, let's take Adyen for instance.
How did this idea come about? Like, first of all,
The idea came about from you.
From
okay. The Adyen idea.
The Adyen idea,
Okay.
it did not come about this year. It came about actually when we started conversing, when I joined DSP in November 2023, when we initially spoke. I think the credit goes to you. And we have been working on that idea for some time, trying to understand, both me and Jayesh. The simple thought process here is that there is a large payment processing that happens globally, approximately 34 trillion of that. In that 34 trillion, this company today does about 1.3 trillion of that processing, about 3.5% market share. And they're growing much faster than the market. They basically, if you swipe the card on Amazon, between you paying the money from your credit card and the seller getting the money, there is a sequence of events that happens in between: authorization, fraud detection, and so on and so forth, including, let's say, आपका fail हो गया transaction, the money has to go back to the buyer. All that is done by Adyen. They own the pipe, they have the licenses, banking licenses, the acquiring licenses and everything, and they have complete control over that pipe, and they have built that pipe on their own over a period of time. And they like that, and they like doing that, and we like it. We like companies which grow generally organically. So we believe that the market is very substantial over the next 10, 15 years, and this company can grow at around 20% CAGR, which is what the management is even guided for. And they don't build businesses for the next 6 months. When they talk long term. In our definition, it kind of syncs with us very well.
I love the management.
Yeah. So I think Ethan, whenever the CFO, whenever he talks, light glows up in my mind.
It's amazing.
So that's the reason we believe that that company can grow 20%. And if you look at the balance sheet, they're sitting on $5 billion of cash. So on a EV/EBITDA reported basis, about 15 times. But if you remove the cash that is there with them from the vendors, it's about 21 times 1 year forward, which we believe is fairly attractive for a global company. And there are very few companies globally where we can put a finger and say they will grow mid-teens to high teens.
Yeah, and there are
Some
so
degree of
many.
certainty over the long term. I think this is one of those companies.
Yeah, and so many mishaps keep happening in payment space. Like Fiserv was the recent one. Like their PayPal is down 70% from the top, and yeah, very difficult industry to make money. And I found it really tough to go in and take positions in these kind of industry, even in my personal portfolio days. So in terms of Adyen, do you also weigh in the fact that the founder has said, like, they would never do any kind of an acquisition, because that seems to be a lot of a graveyard for many companies, because Fiserv has done that too.
Yeah. I think there was a way they had an investor day in November, mid-November. In the presentation that the CFO made, he actually made a remark first time about inorganic acquisition. And there was a question from an analyst. He said, in my years tracking Adyen, you have never mentioned inorganic ever in your thing. Is there a change of stance? Right. He said, we want to do everything on our own, but if there is an opportunity available that meets our criteria without doing anything fancy, we may pursue it. We'll see how that evolves. But it is this investor day, November 2025, was the first reference point of an inorganic probable change of stance there.
Yeah.
But they've all done organic, which is what we like generally.
Right.
Very few businesses that can grow 18% without requiring capital, like very few.
Right.
And they have 55% EBITDA margins?
Yeah, they have quite high EBITDA margin, but it's the return on capital that matters. So even if they were working lower margins and no capital, I'll still own it.
Right. It's a great business. Like I've followed it for a long time, back from the days when it used to trade at 120 times free cash flow, and everyone used to love it. They used to say, like, these all the bear like all the bull arguments were there, but when they went in terms of pricing the other way in North America, people just went, okay, they probably will grow at less pace than 35% in North
I'm
America.
sure it would have been valued differently if it was listed in US.
Yeah, the stock was down 47% on that day. And that was the time that I started getting interesting in it, because since 2020, 2019, 2020, I've been following the company, and I was like, this is an amazing company, but never seems to trade cheap. But that was the time, in
Right.
those 2 months, the spread between value and price kind of started closing a little bit. So it was a good time to own it, and still it is. I believe, like yourself. So it's one of the greatest businesses. Yeah, like to believe. Probably these are famous last words, and we'll know something else happens in
Yeah.
in next 3-4 years. And Trip.com and Tencent. Like, first thing is about China, right? Like, a lot of people don't really believe in China itself, and most of the people who wanted to sell China probably have sold it, considering what has happened in the past 30 years, or like specifically in the past 5 years, where nothing seemed to have worked. Why do you think these positions are going to work for you?
Great question. So I used to be part of a global emerging market team. We started seeding the team in 2013. We managed a fund till 2019. Um, just to go back in history of doing that, in 2014, when we actually started deploying money for the Global Emerging Market Fund, China was approximately in the MSCI EM index 32%. We were 44%, 45% in our fund. India was zero in the pre-Modi rally period. We completely went in when
And this was what time frame?
2013 for 2014 March, I think, when we
Okay.
started
And
deploying.
since when you were like zero weight India?
To March 2013, so March 2014 up until September, October 2014, um, when the post-election rally fizzled out in India. That's when we started going back to India at that point in time. But just coming back to on China, um, I've also lived through the period of 2016, 17, 18, where there were measures by China which did not please investors, and they did for whatever the reasons that they felt very right from their own perspective. I'm not questioning that. I'm just saying each market has its own nuance. India has its own nuance, where some policy measures could come and say you cannot do this business and you cannot do foreign investors are not welcome and stuff like that. So um, uh, China went through that period. In that period, even though broader indices may not have done well, some individual companies over a 10-year period, if you were to look at it 2013 to 2024 as a benchmark, adjusted for this thing, have delivered phenomenal outcomes. Tencent listed in, I think, if I'm not mistaken, 2007 at $700 million of market cap, or $750 million market cap. Today, it's about a $770 billion market cap. It's a significant wealth generator from 2007 to all the way to 2025. It's not a small number by any yardstick. Right. So there are fabulous companies available in China. So it's like saying India market indices has not done, certain period of time not well, but individual companies tend to, because they are so good at what they do, like Tencent, have generated shareholder wealth in the period of time. On China, we don't have a, a view saying that China looks good, let's go there. We see more value there, relatively speaking, but we do have guardrails.
In individual companies.
Yeah, but we do have guardrails in the sense that while we are unconstrained in our thinking, in our portfolio management, in the Chinese exposure, we would like to cap it around 25-30%, knowing very well that we are susceptible to those policy announcements that may come through at some stage or time. So we want to control the risk to the extent that is possible. But if that event were to happen, we will be susceptible.
Okay. Josh, what do you like in Tencent at these valuations, and what do you like about the business? Just
Look,
explain it.
it's very easy to say and get swayed about with the headlines that this index doesn't make money or this country doesn't make money, and then it's like it's funny because the constituent of index are not good. And if you go and look at figure out the similar business economics, it works everywhere the same. It's not like a Info Edge or a Recruit.com would be very different, or let's say a paint company in China or in US or in India would be very different.
But you could have made that argument about Russia as well, right? Like there are
Yeah,
people
so
who went
there,
long Russia and they got creamed.
that is true. So, but the relationship, of course, you have to have more nuanced understanding of the countries. Like those VI structures, I know you have talks really about them. They have raised like billions and billions of dollars through those VI structures. It will be like a modern dishonesty, disservice, which can happen at any time. But at least in this two major power in the economic world would not try to pull that off, and that will cut them economically for like years. And I don't think so. Chinese are that dumb. I think Chinese are much, much, much smarter than comparative to their Russian counterparts or so forth. That's the other argument. But I always say that the difference, there are sectors and the businesses which have very good economics will have a similar outcome regardless of geographies. And I think you have to just figure out those businesses, and that's what the global fund is for, right? You just you have to of course everybody says you have to be in India, right? And you got quality. The India is not like a god's sent country that all the quality business will just come to India.
Yeah.
There are similar industries and business available somewhere else.
But I know like fund managers who would usually say, they would just go into NATO countries or countries protected by NATO and countries which are democratic. And, so how do you think about like communist countries like China, like Russia, because you are exposing to that specific political risk in the portfolio?
In the current economic environment or political environment, tell me a geography which is not susceptible to political noise today.
Noise. I'm not talking about noise. I'm talking about secular decline.
If you put 100% tariff, that is a secular decline for my business.
So I think we refrain from taking all these big picture views because they're very complex. We may not have the skill set to say conclusively one way or the other. How do we control the risk is through portfolio sizing and the choices that we make. Some markets we will stay away because we don't want that headline risk for the same reason. Having done emerging market investing at a certain point in time, in local Brazilian real or Chilean peso, we made money, but when we converted to dollar in certain times, we did not make money because the currency went for a complete toss in those certain markets at certain point in time between 2014 to 2020. So those risks are there. So we don't make any political judgments and say should we be exposed or should we not exposed. In the market that we are where we have exposure, US, Europe, Japan, South Korea, and China, Hong Kong listed Chinese companies or US listed Chinese companies, we feel comfortable as things stand today. But you never can predict
So
geopolitics.
I'm still perplexed about the fact that there are certain countries, where you have not even perplexed, like, but there are countries which exist, where the left tail risk is much higher than the other countries, right? And that's a fact. And you talk about like countries like China, you talk about countries like Russia, and all these countries have more left tail risk because they get into you know problematic situations with the bigger powers, maybe like USA, or like they don't go well with Europe, and because these are bigger powers at the moment at least. So how do you think about those left tail risks? Because these positions can become really lopsided for you when the left tail risk strikes. And that happened in Russia in many stocks.
So if you look at Indian history, I'm not that expert there. If you go back and check the 1998 period when the great Mr. Vajpayee did a Pokhran test, there were sanctions imposed on India.
Right.
So what is a fear? You would have money sanctions, which would mean you would not be able to attract capital, money for FII flow, which was very important to us at that point in time, which domestic investor today is very large. Was a fear at that point in time. So equity values got destroyed at that point in time, even in India. So these are geopolitical matters that are in certain events can trigger in any markets, even if it's democratic too. But I understand where you're coming from. So markets like Russia, we don't go. The only market in that equation which fits is China. If you go and meet Chinese entrepreneurs, I mean, they are fantastic people, I mean, great entrepreneurial skills. If you look at the talent that is there in some of those Western large companies, they come from a lot of Asia, China, India, stuff like that. So I don't know whether to make the judgment as fair, but the risk exists. It's true, but we try and control it to the extent possible. Beyond that, we don't make any qualitative judgment saying that because of communist country, it's good market or bad market. But that's beyond our capability.
And the quantum of narrative also keeps changing. I remember like when 2022 happened and the all headlines was just around CCP finding Babas and Tencent of the world, and now how the world has changed, right? Last 2 years combined, cumulatively, Alphabet plus Meta would have at least spent $20 billion to Europe fine than the US fines. So I don't see it because if any sector which is very crucial to you, you are going to regulate it, or you want to see that one player does not get very powerful. So that happens in every country. It's not very close
No, if
to
fine, if the fine is not part of your expense line item, you're not even doing well. That's how people are thinking about Magnificent Seven at this point. They're like coming to the Magnificent Seven part. Do you still believe there is value in some of these stocks? Because you have Alphabet, Meta, and Amazon in your portfolio.
At this current juncture, looking for the next 2 to 3 year point of time, and based on which we decide our buy and sell framework, we see value in these three companies relatively speaking to the others. But if you were to picture the world for the next 10, 15 years, who are the leaders in this field, be it GPU technology or search or artificial intelligence or office network, cloud? The Max 7s are the big ones. The content media, take Netflix for that matter. I'm not so sure about Tesla's competitive advantage because I can't predict what will happen to electric vehicle 15 years down the line. Maybe hydrogen will come through, I don't know. But between these 6, 7, they are very relevant companies. And they're very relevant companies, not just in US, in Europe, but also in a very large consumer markets like Africa, India, Asia, which is where the large population lies. So I do believe that they are very relevant businesses to own for a very long time, which is why I said when investors should have some allocation to a Nasdaq or a S&P because for this simple fundamental reasons. Now, if I see, do I see value today from a 2 to 3 year perspective in all of them? May not be. In 3 of them, we do, which is why we have it in the portfolio. But at some point in time, we would love to own the other 3 as well at a certain valuation because these are fabulous businesses, and making these big picture calls saying that what will happen next 15, 10, 20 years, who knows? Nobody knows, I think, from that point of view, how it will evolve. But they seem to have so much underlying strengths in their businesses that at every 3 year point in time, something new comes up in these companies, which nobody foresaw. I didn't have the intelligence to see what Amazon would become in 2025, in 2000, 2002, forget about 2007. So
Yeah, Google
these companies keep surprising investors every 3 years by doing something new comes up, they keep rolling.
Yeah, Google used to have this other bets thing, moonshots. And, who would have believed that GCP is part of it? And people used to value that thing as zero. And now one of the biggest value generators is probably GCP after the search. And same thing happened with Amazon but that happened like long back in 2000.
The number of investments that they're doing in health tech today, Google, if you look at the annual reports and see what Mr. Sundar Pichai says in his interviews, I mean, who knows? They could become one of the largest health tech companies in the future. Waymo could become very big. We don't know.
Yeah.
So stuff like that. So I don't know. I don't want to make a statement saying that these Magnificent Seven have passed their bets in terms of valuation, stuff like that. I am not capable of making those statements because these companies keep surprising. every time. So at this point in time, from a valuation point of view, where do we see relatively more comfort is these three names.
Yeah, Bill Miller once quipped, he just said, I come from, someone was asking him about like Amazon in 2017 or 18, and he said like it will double in 3 years again. And so at that time, uh, the interviewer goes, uh, this is already almost a 800, 700, 800 billion dollar company. What are you talking about? Like it was 500 probably at that time. I don't know the exact number. So he was like, it's really large at this point of time. He's like, I come from a time where 30 billion used to be the market cap, and they used to say like no company can be bigger than 30 billion dollars, and infinite, like the pie just keeps expanding throughout. So these are just numbers. Once we cross trillion, it would be 4 trillion today, and it would be 5 trillion someday. And this and 5 trillion has already happened actually for Nvidia. So no Nvidia for you.
At this point in time, are we are not able to narrow the sustainability of that cycle, as opposed to saying that whether Nvidia is good or bad. We think Nvidia is fabulous. There's no questions about it. What valuation that, like when I started at the beginning, fundamentals are important, valuations are equally important, more important in fact. At this point in time, the ascribed value for that business is, we are not able to understand it. Perhaps it's our own handicap, but if we can't understand something, let it go.
Same is a very hard space to understand actually.
And in general, very few things are knowable. Like you can value from 15 to 25, pick a number, whatever you want.
Yeah.
But it's just your head ascribing a value to it. Like actually valuing a business is just so tough. Like how do you value them?
Yeah, it was a graphic chip business and transformed into something else. Michael Burry on one of the podcasts recently on, he basically said, I used to own Nvidia in 2016, 2017. And, at that time, I met the CFO and said, like, you're doing all the right things. You're doing the buyback and everything. Imagine Nvidia was buying back stock at that time. They still do, but like the market cap is so large, you don't virtually realize how much they are buying back. Like it barely makes a dent. And now they are just hiring left, right, and center. And some people believe there's still value in Nvidia. Some people just believe, it's kind of a bubble
They
and
seem to
everything.
have seen value somewhere else also. So they are investing in OpenAI. They see value there. They're not in their own stock.
I mean, you don't know. Like what you are essentially saying is you guys are not able to handicap the demand and supply side of it, and that's been my problem with the semis as well, because you really need to understand that the money is going.
At this point in time, sitting here in December 2025, if you had asked me in that Feb correction, would I have bought Nvidia at the trailing at that valuation? We discussed it internally. Yes, it made sense. At the same time, it made sense to have Samsung Electronics too at that point in time, and that has run up by 60-70% since then. So at this valuation, should we make that call? We feel uncomfortable, and therefore we have not.
Right.
But if that cycle were to unwind, and sometimes this can unwind very quickly based on narrative, then we are ready at a valuation that we have in our mind.
Okay.
And
Makes
markets
sense.
have a very funny way to make you feel how small your circle of competence is.
Yeah, 100% has happened to the best of us. So, in terms of like let's go like a little bit behind the curtain in terms of like how do you reach the decision making, like, and how do you reach certain decisions, and what happens when you both sit in an investment committee meeting and you discuss ideas a lot of times, and are there disagreements? Because Natraj is very value conscious, so is Jayesh. But at the same time, you can be poles apart because Natraj also thinks a lot about like macro, right? And Jayesh is like probably agnostic in many ways.
Because I
Based
understand
on
less.
yeah, that's also possible. So and same with me. So like, what are the debates that you guys have? What are the disagreements on one of the positions that you have had recently?
So let me put first a principle-based answer to that.
Yeah.
So when we both sat and we discussed it, we said a healthy disagreement in a research team is fundamentally important for better outcomes. If everyone thinks the same way, we'll end up buying stuff that we should not be buying. I think healthy disagreements is very, very important and core to a very vibrant research process. Point number one. Coming from experience, like Mr. Great Narayanamurthy used to say, you can disagree, but don't be disagreeable.
Yeah.
So no egos here. Just for the sake of it, we don't argue.
Yeah.
If you're not able to come to a conclusion, then go back and check the facts, bring both the facts to that discussion, and then if you're able to take a call, take a call. Otherwise, nahi samajh mein aa raha to chhod do.
Yeah.
The third point of it. How do we bring ideas to the table? We run many screens, we go and attend conferences, we travel, sell side se baat hoti hai. So all that stuff comes up, and our own analysis as we build the database internally over a period of time, market results in certain stocks coming to a buy limit. When that idea is presented, we have a Thursday research meeting for global, where not just me and Jayesh, Ramneek, you are also part of it. There are a couple of guys from DSP who are also a couple of other guys are also part of it, and we discuss together and we present. And before we buy, that idea is presented to the team, and we hear other people what they say. But me and Jayesh also have to agree. We have I think there is a consensus way of doing it. It's not that Nataraj ko theek lagta hai, jaake kharid lo.
Yeah.
I try to build consensus within the team, saying that why do I like it, why do I don't.
That I've seen. That I've seen. When you guys have your conversation, even when you have conversations with me, like, he's one of the easily disagreeable people. Like, he's one of the most open-minded guys. And same with him as well. So I really like my conversation because, that's how I started my career. Like, I was in the US, like, got interested in stock markets and all of that. And, just like going back and forth on certain ideas that you must have seen on Twitter or like, in the news, and just going back and forth on ideas is just amazing, because then you get a broad perspective to judge Indian markets as well. Because for an absolute purist investor, what ends up happening is you're looking at some company which is trading at some obscene multiple over there, and you just look at the global peer, and that company is trading at half the multiple or like 1/3 the multiple, and then you just go like, this can happen to this company as well, and then you try to build in the appropriate margin of safety.
And the fundamental principle here is also that this is something that I have learned from my earlier company, having worked there for 19 years. That the idea of a consensus is that if something happens to one of us, the investor should not suffer,
Yeah.
because either of one of us is too brilliant or too dumb, either way. So I think that I've learned the usefulness of that, the robustness of that, and it helps to have a healthy disagreement and have a consensus way to build a portfolio and a business over a long period of time, because it can sustain beyond one person.
So, give me an example of a holding. You have been investing only for like about 2 months or so. So, give me an example of a holding that's been up a lot since then, where you both were like, let's take the position a little higher, but you kind of held back, and it was one or the other's mistake in that sense. It's like, मैंने बोला था कि we should have increased it, but we did not increase it. And
I think I'll give you an example of an idea that we missed.
Yeah. Okay.
We discussed Louis Vuitton. We discussed it like Jayesh has. I mean, he will talk about it more. He has done 20-30 year history of luxury goods.
Yeah.
We also had another team member doing significant work on luxury globally, and we discussed Threadbare. We dissected the company, compared with Hermes, compared with Rochemont and all the other luxury makers, and we arrived at a valuation when it was about $240 billion market cap. We said 175 to 185 is where we think the margin of safety is the highest, is when we will enter.
you're too cute about the valuation.
So
Very greedy.
maybe greedy. I think greedy is the right word.
Yeah.
And since then, the market cap today is, I think, if I'm not mistaken, to $330 billion. So China news came saying that there's a pop, and they did better than numbers. And the better than numbers was a 0.2% difference. I mean, it's not like
That's all you need when the sentiment is down.
20 against 2. I mean, they did not do that. So that was one aspect. With a benefit of hindsight, we keep discussing, at least I keep discussing to him, maybe we missed it. We've been too, we should have built at least a 1% base position. And then if it were to fall, which is what we did with Puma, it was an absolute distorted share with underlying fundamentals deteriorating with the potential of movement. There we had complete consensus saying that we should build a 1.5% position. We built. It fell by 20%. It is now back to where it is when we bought, and slightly higher too. But these things happen in this no regrets per se. But can we be better in the process? What did we miss? What did we not miss? That analysis always happens. At this point in time, he's very clear that $185 billion is the right valuation, which I agree. which I think I don't have a problem, because that's the margin of safe. That's the level at which margin of safety becomes very high. So you miss ideas.
Right.
Maybe we missed that the weaker brands were not that as weak, or we thought we had a luxury of lot of margin of safety.
So essentially, what we did was we did the Louis Vuitton business, the brand. So they have number of brands within that. The LVMH valuation we did right number, but certain other smaller brands or niche brands, we said we want it for free. Call it greedy. But that's the way.
But that's the right way in so many other investments that you go, because you don't know, again, the left tail risk kind of scares you a lot of times. So it's better to have those margin of safety, and probability of you being right in that space is much higher if you keep taking those calls, because what happened with this idea is not like repeatable again and again and again, right? And if you're not sticking to the margin of safety,
because if you value those businesses, weaker business at even, let's say, reasonable valuation also, and if you go wrong, that's not recoverable. That's gone forever now.
Right.
So it's better to miss 5-10% than let's see.
Tell me a little about Lululemon. Like, why do you like it? Because it is one of the fashion brands. People really hate retail, right? And the investors you talk to, the old guys who have been in the markets for a very long time, not like age old, but like the people who have a lot of experience, they just say, like, just stay away from fashion, retail. There's a lot of graveyard over there. But there have been great comeback stories as well, like Abercrombie and Fitch. So what propels you to go into something like Lululemon? What do you like there?
First of all, it's not the largest position in that sense.
Okay.
Like, it's not like we extremely love of course, it's a tough industry. Everybody knows that Paris has a fashion cycle, consumers are fickle, they change their opinions on everything. They're like just us, like how we change opinions on stocks. So, and the quality of perception is also driven by prices and everything. But as a brand where the pyramid stands right now, at least in athleisure, they have a very high share of mind, at least in as a quality perception as of today. And that is not just like a survey thing, but to get an throughput for the direct retail. It's like most of the brands actually make money through some wholesale channel and through direct channels. So you have to figure this out. What are the brands who have a direct control on the retail out front and still make return on economics, because it's a costly distribution, right? If you go put your own store, pay the rents, get the staff on the line, and everybody would want to do it, but cannot do it probably because you have to have a throughput store for economics to work out, and then have a vendor system. People also want to be asset light, but then you can't control the quality. So he has built out the vendor system, also invested in them, and get the whole vertical integration. Very few people can do that, because you have to have a brand which sustains that kind of a cost in a low cycle, because if you can't, then you are out of the business. So you will have a one fad cycle, and then you are again under the water. Lululemon has done that significantly. Just to give you an example, like and the next two competitor put together has the same number of stores in US plus Canada, but the throughput from those stores is 1/4. So that's kind of a difference, right? So you can go and have an competitive pressure and use the capital and still not bring down the throughput of the top player, then you are on a decent zone. Now it is available around roughly 12, 13 times, given the operating margins, what you want to take, given the tariff hits is going to come or not. There has still a lot of room to grow, right? There are not many stores in China. There are not many stores in Europe. There are none store in India itself. So there is still a room to grow there. And given we believe that the brand is not as a fad as like other brands. Of course, it's an industry which is difficult, but I think they have carved out a niche for a segment which is athleisure. Athleisure has a slightly lower demand cycles in that sense. Let's say if you're in an office wear, it might be more susceptible to cycle, but for fast fashion, you have to be very competitive, very fast. So what Inditex has been able to get the inventory system right? Get everything under one roof and get the feedback cycle, lower the lead times and so forth.
Inditex is the owner of Zara.
Yeah. Sorry, Nvidia is the owner of the Zara, and they have cracked the inventory model which Zudio is trying to do in India and set at the lower price points. Once you get the supply and the feedback cycle from consumer demand to the get the supply right and get the inventory made and then sell out has to be very short. Unless you will predict a demand cycle, then you place the inventory in the store and then you say, "Arey, customer doesn't want it anymore." So you have to shorten that very fast. So Inditex have been able to do it. Lululemon is not in that fast fashion zone, and health as a segment or a fitness wear is also picking up trends. So the penetration of those levels will also go up. So we are not building like a very hefty growth. Maybe US might go at single digit, maybe flat or maybe 4-5%. But China is actually growing at 20-30%. So if you do China is currently small, international is slightly small, but if you do a combined growth, and we hope so, I'm not sure, we hope so, it delivers 7-8% growth, and the return on capital of this business is very high, like 40-45%. So they really do not, even if they're not growing, they just can give back the capital. So that shareholder yields be around 4.5-5%. So broadly, you can make 11-12% of this. I know it's not very high, but reasonable for us.
As you see, like, like shifting gears a little bit, INR keeps falling against the dollar, and that's been the structural makeup of the market since India got independence in 1947. It has been a declining rate since, like, what, 3.5% or so since independence. Yeah, 3.5 or 4%. So, like, does it bother you, or are you a cheerleader of this kind of a depreciation in Indian rupee? Because
for the depreciation, you have been rewarded with a higher earning growth also. So you have to account that also for India.
No, I'm talking about the USD.
Yeah.
So from a strategy point of view, we invest in US dollars. The NAV is in US dollars. If an investor redeems, if the rupee is depreciated, then the return is enhanced. If the rupee is appreciated, the return gets compromised to an extent of that appreciation. But the longest story short, if you look at the long-term period, is about 3.5% depreciation. We don't know where it's going to go. I just have a favorite topic between 2007 to 2011. There was a period where rupee was pretty much stable against the dollar. In fact, couple of years, rupee actually appreciated. It's not that it happens every year with certainty. There's nothing certain in the world except death and taxes.
Ben Franklin said that, right?
Yeah. So from that point of view, I don't think it's a given that will happen. We don't know, given the circumstances that is there in the US, what is going to happen to dollar. It's not just about the rupee itself. But from a strategy point of view, we don't take those decisions, those calls or hedges, or even the global currencies. But from a simple way to look at it is that as long as the textbooks tells us that as long as there is inflation differential, i.e. India inflation is, let's say, 6%, US inflation is, let's say, 3%, all other things remaining the same without any complications, the difference of 3% should be the impact on currency. That's the way to simply think about it.
Okay.
There is a lot of other complications like capital flows and regulations and stuff like that. I don't want to get into that. But as long as that remains the case, which it will be over the next 5-10 year period of time, because we are faster growing country, We have a lot of people. We have to move up from the lower income to higher income, which means we need to invest as a country. The currency may remain weaker in the very long term. In the 3-year, 5-year period of time, we don't know.
So, sitting over here in India, how do you feel your edge is compared with, like, someone running a fund globally, traveling consistently? They are going to Europe, and they are going to traveling to China. They are traveling to the US. I know you do some travel as well, but uh, here, while India is asleep, like, how do you think about like managing a portfolio uh, which competes with a portfolio which probably has 300 analysts behind it?
Probably we get less simulated.
That's true. That's true. Yeah, it's like a Omaha thing, which Buffett basically says. Like, said throughout his life, being away from Wall Street actually added to alpha.
I don't know, is there information edge?
Yeah.
The information edge, is it for 8 hours? Is it for 800 hours? I don't think there's any information edge over 800 or 8,000 hours. So let's leave that. The understanding of a business um, and things like that, because of our travel information or because of digital infrastructure, information access has become a lot easier. Access to companies have become a lot easier. Access to global analysts have become a lot easier. I'm not saying that we are better off or they are better off. I'm just saying that if I take Maruti Suzuki in India, or if I take Tesla internationally, do I need to know what is happening to every dealership in every geography of Tesla to make a better informed decision? Perhaps, maybe. But is that information edge over a period of time? I don't think so.
Yeah, by the way, all these companies that we are talking about, they are in the presentation of our Gift City. So, talking about like being long AI trades as well. So, it's like you have like, Amazon, Google, and Meta in your portfolio. Like, but which of the companies, let's say AI just automates 20-30% of the white collar workforce in the next 10-15 years, which of the companies do you think that are there today would just disappear? Or and flip side of it, which of the companies would do exceptionally well if that were to happen? And I know,
Can I ask a question? If when you may automate, the 20-30 people will be jobless?
yeah, there is like there would be less need of that.
What happens to economy is something that we have to first worry about.
Our job.
I think economical impact, we don't know what's so the productivity gains coming out of AI should compensate for the job losses for the economy and aggregate basis to do well. So there has to be some compensating factor. I think if that were to be, let's take a simple scenario that 20-30% of the workforce will be jobless 10 years down the line because of AI. We have a bigger problem, and it'll affect every company in the world, in every country in the world.
But which company benefits the most from this? There must be something that is getting benefited from this. Obviously, the consumption will may go down, and like productivity gains don't come. What will happen then?
Media companies who talk about AI.
Sorry?
Media companies who talk about AI, they will definitely benefit. It's really difficult. Very difficult.
Very difficult to understand. Handicap right now.
Yeah.
Okay. Why do you have 40% cash in your portfolio? Don't you get don't you get into this the tailspin of thought where you are just thinking like you could lag behind badly if 1 or 2 days of rally would come?
Cash. So we think we are not that intelligent to take cash calls. Cash is simply said, if we can't find opportunities that meet a hurdle rate of return expectations within the coverage universe, which is growing and we are building, we stay on the sidelines until we build convictions. So in the last month, when 1 month or so, Nasdaq is down about 2%, depending upon which day you choose. There are stocks which have cracked even more than 15-20%. We bought one software services company last month. Cash allows us to make that decision, quick decision to make the choices. Um, uh, we don't feel scared. We think the 21 stocks that we hold in the portfolio are great compounders over a period of time. that will deliver much
Where is
better.
the fact sheet of this fund available?
The fact sheet is available on the Gift City website.
Okay.
So coming back to that point, yeah, I think we are not worried on holding cash, but in the, like I said, the 25% exposure to consumption names, in those 2-3 consumption names that we spoke about, we only built a base position, and we want that cycle to show some catalyst, the catalyst to play through and the recovery to happen. And then as we build more confident in this existing position of the 21 stock itself, we think we have our ability to add another 6-7% more in these existing companies itself. So I think that's the way we are looking about it.
Any mega cap in the US that you feel is like sort of a melting ice cube where people are getting things completely wrong? The valuations are just high and you think, the company is not on a strong footing.
Wow, very good question. Very difficult to answer. That is a melting ice cube.
I can think of, let's say, a consumer durable company like a Honeywell, for that matter, current valuations of
But that's not a mega cap. It's sub 100 billion.
Accenture. In some sense, I'm torn with respect to software services as a business, what AI would do to that business over the 5-10 year period of time. Will they currently trade at the valuations that they trade today forever? Because they have all derated in the last 10 years and they continue to derate. So we don't know what's going to happen from that point of view. So will they exist in the current form? What they have to do, reinvest? So there are businesses like that that worries me. Therefore, we desire much higher margin of safety from that point of view.
So if you would have to short, let's say 1 or 2 companies with 10% of your portfolio, are there names in your mind?
Globally?
Yeah, let's say you have a mandate where you have to short 10% of your portfolio. Would you short any? Like, do you have names that come to your mind?
Slightly longer term perspective. So if you take some of the memory companies that have run up, I think NAND DRAM memory is a very cyclical business. Not all of them may fail, but some of the marginal on the
See, I'm not saying it. You said it. You're going to short Micron technology. That's what you're saying.
Micron, maybe even Seagate for that matter, which has rallied about 7 times in the last 6 months, if I'm not mistaken.
I have one answer. MicroStrategy. This Bitcoin treasury companies. Have you heard about this company? Like,
Yeah, I know. It's strategy. It's called strategy now.
it's called strategy now. Yeah, you're right. It's called strategy. Maybe that. Yeah. Maybe you can create a trade out of it. You can be long Bitcoin and short.
It'd be so crazy if you short it. Like, you could have your head handed to you. Like, that's also the thing, right?
But if I don't want to go short and take that risk where downside.
Like 3% short karega or 33 times ऊपर fund wiped out.
Very true.
I think global refining is other pocket where pure refining companies is where I feel very large refiners, where I feel given the energy transition that we are seeing and also electric vehicle movement, whether it is electric vehicle or hydrogen, I don't know the technology, or hybrid or combination of it. The largest market in terms of capacity is now saying no more additions of refining. We are going to become, neutral in by 2029, 2030. I think the refining side looks very difficult to me from a longer term standpoint. That looks very edgy. The more I hear, more I speak to companies, more calls I hear, I think some bit of disruption is due.
Yeah, it is crazy to me. Like, if you have a pure refining business and you haven't deviated your resources in some or the other decently making ROE business in the past 5-6 years.
I think anything. So if I'm upstream company, I'm incremental capital is going to businesses like renewable energy or hydrogen gas, unproven technologies where capital efficiency is not proven, like a refining. So incremental capital deployment is actually worsening for these companies. We don't know the outcome of those investments. We may come to know 10 years hence, but at this point in time, that side of the equation looks very dicey to me.
What do you tell a 30-year-old today to buy and hold a fund or an index fund or an active fund and forget about it for a for about a period of like, let's say 15-20 years, what kind of funds they should be in if they have to be globally diversified?
I think US will still make sense. I think US should be a larger allocation in that.
How large?
If let's say 100 rupees is what you want to invest globally, I would still say 50-60 in the US over for that time horizon, because it's been proven and again that companies there, because of their ability to attract capital, talent, which I don't know what is going to happen in this current political circumstances, they reinvent themselves, make them relevant again and again in different cycles, and they are leaders for very right reasons. So I do think that US should be a larger allocation, whether it's Nasdaq, S&P, Nasdaq more than S&P in my view. It should be the way.
And your fund?
Yeah, and then I was coming to that, and then on top of that, if you were to choose an active manager who doesn't think like an index, or an active advisor who doesn't think like an index, bottom up, very long term, perhaps 3-5% allocation to start. And once you feel comfortable with the process, we do what we say we do, not just for the podcast, but actually it reflects in the portfolio and and how it behaves over a period of time. Then you could increase the allocation over a period of time. But I think if someone were to start building the portfolio, I think US should still remain a very large allocation, because those are fantastic managements and fantastic companies for the very long term. I mean, who knows 10-20 years hence, but these looks like winners today.
Considering like Elon Musk is catching rockets, coming back from the space and and helping with the cost savings of the rubble. I read some report which basically said like they would save about $30 billion in those expenses throughout the industry over time. So this is the kind of innovation that keeps coming out of the US on a regular basis. And then AI, and Jensen Huang was one of the one of the podcasts recently, and he said technology has always been a race, and you have to do well over time. Like US was able to implement industrial revolution while Britain basically kind of just started it, and they were just engaged in like talking about policies. US kind of implemented it en masse, and same thing happened with internet, and now same thing is happening with AI. So he says this is a race, and that's how the people in
I mean,
the
who
US
knows
think.
20 years ends, but at this current juncture, looking at the world where consumers are, how those consumers are relevant to those companies listed in the US, how they're able to capture their imagination to become very relevant to them. I mean, these are the companies that you want to be invested in for the longer term for sure.
Right.
As things stand today, who knows what will happen 5 years hence.
And tell me a little bit about the taxation of the gift.
Let's say a simple equation. I, as Nataraj, wants to buy Google share on my own through a broking account. Any selling that I do within the first 2 years attracts a marginal tax rate depending upon the tax bracket you are in. Similarly, in this fund also, if I buy a share today in the fund and if I sell within the first 2 years, then there is a marginal tax rate of 42% and a half percent, whatever the number is applicable. And after 2 years, it becomes a long-term taxation like a Indian equity. So that's the simple way. The only other major difference is that any interest income that I earn on cash that I invest or dividends that I received is also taxed at a very high rate in this fund.
So what's the total tax like once, let's say, you end up investing in a stock and you figure out, like, 3 months down the line, probably, things are not going well, or you just don't feel the comfort that you had, or you were just wrong in your hypothesis that you had earlier. And now, let's say you have had gains of, let's say, 100 rupees. What happens then? Or $100, what happens then?
So if I invested 100, it became, let's say, argument's sake, 150. On that 50, if I sell within 2 years, there is a 40% tax. So which means instead of 50% gains, it'll be 30% gains. The taxation would be paid at the fund. So when you as an investor or any investor were to redeem that NAV, there is no tax applicable on that.
Okay.
Whereas in a mutual fund, you redeem the NAV, you pay long-term, short-term, or set off whatever you have to do. The taxes are calculated by you. In this case of AIF, the fund assumes whatever the taxes that needs to be.
So your NAV would
reflect that.
Reflect that.
Correct.
Okay, got it.
So there is a subscription NAV, there is a redemption NAV. The subscription NAV is when you come in. The redemption NAV assumes a certain amount of taxation, long-term, short, depending upon the underlying holdings, and reflects that. And that redemption NAV, when you redeem, let's say the number is $10.5. Whatever the rupee exchange that happens, it gets converted in rupee and comes back, reflects back in the account. On that, you don't have to pay any tax.
So every position that you must be taking, you must be thinking that we have to hold this for more than 2 years. That's the thought process going.
Irrespective of this
Yeah.
taxation, that is the thought process.
Agree.
Does that change because of this? The answer is no.
Yeah.
And I'm being very honest about it. It doesn't change, frankly. But let's say, for example, if I invested in a stock, it increased 50-60% in a 6 months' time, which met all our return threshold expectations. And there is another opportunity which is available with a similar upside. Then we may make that decision to sell, bear that capital gain because there is a better opportunity available. We will make that, but that is a case basis. But the idea is let that beauty of compounding work by staying invested in companies that we like for the very long term. Is the fundamental principle where we started.
And you were managing the money earlier also the same way, right? Right now
The taxation, so tomorrow it may change. In February 2026, something else could come in the budget which may change or negatively, positively. You can't plan financial planning can never be done with one set of taxation at that point in time with in mind. What happens after 10 years, we don't know.
Yeah.
Like we have capital gains and short-term capital gains, ASTT. So many things have come up in India in the last 10 years, 15 years.
Yeah.
So I think we should keep that aside. Fundamental principles of equity investing is that if you like a business at a valuation and there is a long-term opportunity to compound wealth, stay invested. As long as valuations don't become too outlandish, at which level margin of safety becomes close to zero, then there's margin of losing everything, then sell everything and probably stay in cash if there's no option available.
Thank you. Thanks for being here. And it was a great conversation. I learned a lot, like I always do whenever I talk with you.
Thank you so much, Ramneek.
So, do you have any closing thoughts on the conversation that we have had? Anything that you want to say?
This is my first podcast.
So okay.
So I was quite nervous about it,
Yeah.
quite frankly. But so far so good. So enjoyed it. Thanks for the time.
You asked him question, what will you give your 30-year-old self-advice, and that is still 2 years ahead for me. So I was just listening. Note down kar leta hu main.
Yeah, I mean, I was asking for the 30-year-olds in the audience. So, but
मैंने भी notes लिख लिए.
you are younger.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.